Well, sticking with financials, private credit exposed names also with big losses. BlackRock and Jefferies seeing the biggest drops. BlackRock falling after it limited redemptions in a private credit fund due to a surge in outflows. So how concerned should investors be about the credit market? Joining us now is Marc Pinto. He is the global head of private credit at Moody's. Marc, it's great to have you. So you say it's a perfect storm in the sense of what is driving this instinct for investors to pull money out of private credit, but it's not a credit crisis. So explain exactly where this friction's coming from.
Yeah, not at this stage. It's not a credit crisis. It's really more of a liquidity crisis. And the perfect storm is, in effect, related to sector concentrations, dividend cuts, additional or elevated redemptions, and then against some of the macroeconomic backdrop you've just been talking about.
So because the private credit funds have loved lending to software, because a lot of investors rushed into this asset class, maybe thinking that the funds were a little bit more liquid on a real-time basis than they were. So that's what we're dealing with now. But you don't think that the underlying credit worthiness, the default profile is getting worse at a rapid rate?
Yeah, no, at the current time, we're seeing this really more as a liquidity issue. And less as a credit issue. Over time, if a liquidity issue is extended, it can turn into a credit issue. What you're seeing today is a relatively new type of vehicle that private credit lenders began to sell and attract retail investors into. And these vehicles, though, are illiquid, are filled with illiquid assets. And I think they were sold as semi-liquid funds. And semi-liquid is a very fuzzy definition, I would say, and not completely accurate for how these types of vehicles work.
At what point does this become a concern, Marc? At what point do you think it smells like a crisis? I mean, one thing can, a liquidity crisis can beget the credit crisis, to your point. So at what point do you say, you know what, here we are?
Well, we're going through this redemption phase right now. And so you've heard about some of the private credit lenders for these perpetual non-traded BDCs raising gates. Effectively, they're not really raising gates. The way investors should be thinking about this is when they invest into these vehicles, they're putting money into a gated community. On a quarterly basis, the board of directors at their discretion can lower gates and allow up to, there's a soft promise of about 5% of the fund's assets can be redeemed by investors. What we've seen is investors seeking to redeem money that was higher than the 5%. And as a result, many of the private credit lenders have said, okay, if there's 7% redemptions, we'll honor those. If there are 17% redemptions, we'll honor those. So it's created a little bit of confusion. I would say we're at a watershed moment here. Let's call it a test. And I think the private credit lenders have passed this test, not with flying colors, but they've passed, and they've been able to pass it because asset quality has remained quite stable. And the evidence of that is, for example, when Blue Owl sold $1.4 billion of one of their of assets within one of their funds, and the investments were sold at par. In a 1 quarter's time from now, we'll go through this again, where people will line up, They will seek to potentially look for new redemptions, more liquidity. And at that point in time, the question is whether, if needed, can these private credit lenders sell again at par?